Good morning, ladies and gentlemen. Welcome to the SERINUS Energy PLC H1 financial results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions at any time and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll, and I'm sure the company will be most grateful for your participation. I'd now like to hand over to CEO Jeffrey Ord. Good morning.
Good morning. Thank you. And welcome everyone to the SERINUS Energy financial results for the 6 months ended the 30th of June 2023. I'm joined today in London by Stuart Morrison, our COO, Vlad Ryba, our Group Controller, and Calvin Brackman, our Vice President of External Relations and Strategy, is also on the call. Highlights for the period. Our production averaged 677 barrels of oil equivalent per day. That was 144 barrels of oil a day equivalent per day in Romania and 533 in Tunisia. In Tunisia, the productions remain stable. We're increasing it slightly here and there. We look forward to a lifting. The next lifting is early October. So we'll do another lifting in October, probably roughly the same size as the one in May. The Sabria N2 workover well commenced on the 2nd of May. All the wellbore restrictions were removed. That was a quick workover. The team did a great job. There was no issues along the way. There was a 40-meter section of the reservoir that was perforated, and those perforations immediately began flowing. The well is currently flowing to surface and it's dewatering. So there's been questions. Yes, we've seen oil and gas shows, but right now it's mostly water. And Stuart, do you want to describe exactly what technically is going on with the dewatering?
Yeah, sure. It's not a surprise that in a fractured system that we need to dewater the fractures to enable the oil from the matrix to expand into the fracture and then be produced to the well. So we're in that stage. Now, we'd like to accelerate that process, and we're talking with partners on the best way to do that. We believe that treatments can enhance the well productivity. So solvents to remove more of the old mud. We got some out, but we may not have got it all out. And acid treatment to improve the productivity index of the well. So those are the next stages on M2.
So the well's flowing. It's flowing under consistent pressures and consistent flow. We are not getting the production we would hope from a 40-meter perforated section. So that means that there are blockages in those perforations, which we believe are old drilling mud. And so acidizing the well to clean out that old drilling mud, working on the acid recipe. So different muds, different rocks need different recipes of acids. And then getting our partner to agree that this is the next step forward. That's the work we're doing right now. This will continue to dewater, and what we'd like to do is increase that rate so it dewaters faster and we get to the oil. And that's the work that's going on now. We've talked about the W1 well in previous presentations. That workover ran into a lot of obstructions in the well. And the difficult but correct decision was made to suspend that well to do a sidetrack. The estimates at the time were it would take 63 days to mill through at the rates we were milling through all the obstructions versus 21 days to sidetrack. And so if you're just working on a day rate on a rig, you can see that there's a considerable savings to come back and sidetrack and not have all the worries about milling through and understanding whether your wellbore remains intact after milling through it. So it was a difficult decision. I know everyone was hoping we'd get a pump into that well very, very quickly, but it was the right technical decision and a prudent technical decision. Plans for the sidetrack are in the works. Those aren't just as simple as, kicking off. There's a deciding whether we try to intersect a horizontal leg in W1, whether we just do a vertical sidetrack, where we want, if we're given a clean sheet and we can pick where we want that sidetrack to go, deciding if we're in the best place at that horizontal section or whether there's a better place we can put it. And that's the work that's going on right now with our partners and with external consultants. We are looking forward. Looking ahead, we'd like to drill 2 new wells. And so the work is going on to identify the best well locations in the Sabria field for new wells. We know that the old wells are not as good of producers as our modern ones. Win 12 and Win 13 are very good producers. So modern wells will give us an enhanced production. In Romania, we talked in the first quarter about the block-wide geological review. That will focus our exploration activity and refine our play structures. So we've done that work. We're now looking at planning where our next wells might be. A reservoir review has identified a whole bunch of gas zones, additional gas zones in the current wells. So we've talked about this before. We talked about when we first drilled the wells into the Maftina field, that what we called behind pipe gas. These were zones that we bypassed to perforate and produce out of better zones or bigger zones. So those gas zones still exist, and looking at how to bring those back into productions via short interventions using a light workover rig to increase the production in the field. And last but not least, we do have 100% of the Maftina block as per the ICC award that was awarded to us. And so we're moving ahead with that block. Some highlights before I hand over to Vlad to give the details. Revenue for the 6 months was 8.9 million, gross profits of 0.8 million, EBITDA of 0.5 million, and a net loss for the period of 3 million. You can see from those numbers and the previous period numbers, so the first half of 2022, a dramatic change. That's almost all to do with a commodity price. Commodity prices have fluctuated. Gas prices are starting to recover in Europe. Oil prices have been relatively stable, so the Tunisian production has been relatively stable, but we're still $7, $8 a barrel higher now than our last lifting. So whilst oil has been more stable than gas, there are still big fluctuations going on in commodity prices. Capital expenditures of $5 million for the 6 months. That was 4.5 in Tunisia. That's the workovers. And just a little maintenance capital in Romania. I'll talk about the commodity prices are important, but I think it's also important to note that, we are in a high inflationary environment. We're not escaping the inflation that we see in other parts of our lives, but we're managing that as best we can. I'll hand over to Vlad now, and he can run through some of the details.
Yeah, thank you, Jeffrey. Well, as I said, revenue is just below 9 million, which is compared to the previous comparative period of previous year of 29 million. Again, it's predominantly impact of the commodity prices being lower, with our realized price for the half year being just below $75 per barrel of oil equivalent, whereas in previous period it was $154 a barrel of oil equivalents, which is having an impact on our netbacks, which is also down from what it used to be in the previous year and the comparative period of the previous year. It's down to $31 per barrel of oil equivalent. And the production expenses and cost of sales, they are down as well, but we managed to keep them under tight control with the strict controls introduced in both Romania and Tunisia, which allowed us to keep them to low level in a high inflationary environment. In the current high inflationary environment, So as I said, production expenses are 4.2 million in the first half year of 2023, where it was 6.1 million in the previous period. And the group production expense per barrel of oil equivalent is $35, which is kind of split between Romania and Tunisia, with the operating netback being $31 a barrel. our G&A in the business units in Romania and Tunisia and at the corporate level in London has gone down significantly compared to the previous comparative period of the previous year. With the corporates, with the usage of funds, most of our cash flow is coming from Tunisia, whereas Romania has been consuming cash and in a negative cash position. So the funds generated from operations overall amounted to about $400,000. Most of it coming from Tunisia, offset by about small portion in Romania, and the corporate consumption was about 2.6 million for all of the corporate costs. And that resulted in the EBITDA of $500,000 compared to $8.7 million in the comparative period of the previous year. The capital expenditure, which we incurred overall was $5 million, with the $3.4 million being directed towards the workovers in Tunisia, and a small maintenance capex in Romania of $500,000. That's pretty much it.
Good, thanks, Vlad. We continue to focus on environment and safety. In Tunisia, we've had 2,801 days with no lost time incidents, and in Romania, we've had 1,565 days. This remains very important to us. We do have an annual environmental inspections by local regulators, and we do our own fugitive gas emissions reports annually, so those are available on our website. So in summary, we continue to generate cash flow. I think we've always said we match our capital programs to our cash flow generation, so it's important that we manage our costs so that the majority of that cash flow is available for our operations and the developments we want to do. We are lucky that we have a large asset base. We have a large field in Tunisia, and we have a large concession area that's proved to be gas prone and proved that we can produce the gas at profitable rates. Existing production funds our core business and our near-term exploration and development. When people want us to drill 4 wells in Sabria, they must remember that we accrue the operating cash flow to drill those wells. So the speed of our development is determined by how much we produce, the commodity prices, and how much free cash flow we can generate. The N2 well has been recompleted and we're dewatering, so we're hopeful that will start producing for us shortly. And we have some very excellent exploration opportunities to expand our position in Romania. So ongoing plans, I think I've run through them. We've got big assets. They are good quality assets, and there's lots to do on them. We've done the reviews. We're technically positioning ourselves for more work next year. And workovers and the sidetrack on W1 will continue when we have the capital to allocate to that. So it's a capital allocation story and it's a growth story. And we proceed along those lines. And that will conclude the formal presentation. We'd be happy to take some questions.
That's great. Jeffrey, Vlad, thank you very much indeed for updating investors. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of the screen. But just while the company take a few moments to review the questions submitted already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, will be accessed via your Investor Meet Company platform. Jeffrey, Vlad, we did receive a number of questions from investors ahead of today's presentation, so perhaps if I may just start with those first. The first one reads as follows: the company has extremely strong proved and probable reserves and is trading profitably. As of the 8th of August 2023, the market capitalization of the company was just 4.3 million. If the market is going to refuse to recognize the value of the company, what can management do to bridge that gap? And I would suggest that the company initiate an aggressive 10% buyback of the outstanding shares for just £430,000 the costs.
Thank you. Yes, I would agree. There's a startling gap in value between the market capitalization and the true value of the business. On the screen, you have a picture of the condensate tanks at the Moftino gas field. The scrap value of those condensate tanks is almost exactly what our market cap is. that means everything else in the company, Tunisia, the production, the cash flow, the earnings, they all are for free. We've tried very hard to adjust that gap by describing exactly what our financial situation is and the opportunities in the business. So we will continue to try to describe that. But there's a very surprising gap. Unfortunately, shareholders voted against the ability of the company to buy back its own shares at the annual general meeting. So the suggestion that we could buy back an aggressive buyback of 10% of our shares for 430,000, we are not able to buy back our shareholders because shareholders voted against that resolution that management put to the shareholders in the recent AGM. So we can't buy back shares.
That's great, thank you. Let's turn to the next question. To build cash flow, we require more producing wells. While Tunisia needs a series of workovers, it looks like the best opportunity. What is the expected cost of the pump installations and future expected works? And what is the estimated output following this?
The best answer to that question is the expected output. We've published that in our corporate presentation that's available on the website. We've had third-party engineers take a look at what pumps could do to the Sabrina field. That analysis is available on our corporate presentation on the website, and that third-party engineering firm's view of what the upside in terms of production from those pumps could be. What is the cost of pump installation and the future expected works? Again, in the corporate presentation, we've laid down the wells that we would like to put pumps into. The cost of the pump is about $350,000 per pump. And then there's the cost of the workover. Essentially, to install the pumps, you're cleaning out the wells. Now, as we've seen, we have a budgeted cost for workovers. In the W1 case, we ran into obstructions in the well, and that's going to be more expensive. And I think that was gross a $4.3 million workover. That's gross, so we have 45% of that. And then in the end, too, that was very, very quick and smooth workover, so it was much less. But the cost of the workover is related to the condition of the well that you're going into, the depth you're going into. So there's not a standard cost. But I think the budgeted cost for W1, which is probably our most complicated because it had a horizontal section in it, was 4.3 gross, and we're 45% of that. So the cost and the expected outputs, that's the cost and the expected outputs are available on our website in the corporate presentation.
That's great, thank you. And then maybe the final pre-submitted question, if I may, is the company still attractive to lenders if needed? If Tunisia workovers and Romania drilling require, for example, 10 million of financing, are we confident that this can be achieved on a non-diluting basis and without the need for convertible bonds, which may destroy shareholder value?
I think oil and gas lending is very, very difficult, not just for us, but for everyone. There's not a lot of appetite for oil and gas lending. However, where there is appetite, it's for fields that have large resource in place and large and proven probable reserves, which Tunisia does have. The cost of that lending is much higher than it was in years past. And for a $10 million work program, we would prefer to accrue that from operating cash flow than go out and debt finance. So debt finance is a difficult one. The availability is much, much lower. The cost is much higher, but where it is available for fields like the Sabrina field.
Thank you, Geoffrey. Well, that takes care of the pre-submitted questions. So thank you to the investors that submitted those ahead of today's meeting, and also for those that submitted the questions during today's live meeting. If I may, Geoffrey, if I could just hand back to you and ask you to read out the questions and give a response where it's appropriate to do so, and then I'll pick up from you at the end.
Sure. The first question, what is the cash situation and how much will the acidization process cost? The cash situation is we had $2.5 million at the end of the period. We're of course spending money and earning money along the way. So cash is coming in. We'll have a big whack of cash coming in when we do our lifting in Tunisia, and we continue to invest. So that cash situation goes up and down, but generally we had about $2.5 million at the end of the period. How much will the assetization process cost? We have looked very tentatively at about $400,000. That is the recipe for the asset. The workover. We'll need to get the rig back, and we'll need to have the equipment back on site. So the assetization is about $400,000. But of course, the benefit of that is we can increase the flow of the water and dewater that well much more quickly. So that's really the proposals have been made to our partner. That's in the hands of our partner right now. And as everyone knows, we have a 45% working interest and operatorship of the Sabrina field. And we have ETAP as a 55% partner. So they need to agree with our proposals and what we're planning to do. What are the plans for the Sturgeon Lake assets in Canada? Are there any prospects to begin operations there at some point, or perhaps selling this to advance investments in Tunisia and Romania? The Sturgeon Lake assets were acquired by the previous management team. They've never produced. They're essentially a series of abandoned assets or assets that we're trying to abandon. The company has $1.3 million on deposit. That's US dollars on deposit with the regulators in Alberta for the abandonment of those assets. We would like to abandon those assets right away, but access to the tribal lands these assets are on has been restricted. We've managed to abandon some of them, but it's a long, slow process on tribal lands in Alberta. There is no prospect of operations there beginning at some point, nor is there any prospect of selling abandoned non-productive assets. So those have been abandoned and non-productive for as long as I've been around the company. They sit on the balance sheet because there is a cash on deposit to ensure the abandonment of those assets. Should we be concerned regarding the falling production rates and cash flows in Romania causing operations to be loss-making? We looked back. We did a little bit of a look back at the Moftino gas field. And what we did, and what anyone can do, is take a look at the 2019 reserve report, the reserve engineers' predictions of production and what that field could deliver prior to it starting to produce. And then we compared to our actual production, what we've done versus what the reserve reports predicted. We have outperformed the reserve reports. That field was to have been a 4-year field. We'll stretch that to 5, maybe even longer, depending on these behind pipe reserves. So should you be concerned with the falling production rates? Romania is a short life, shallow gas field. It was always a quick producer. It produced, it gave us the cash flow for doing other things, and we've used that cash flow for doing other things. So no, the cash flow is going away. Romania right now is essentially washing its face with the current production and the current very, very low gas prices. We would expect to be able to put more gas on production by attacking this behind the pipe gas. And eventually, over time, Romania will revert to being solely an exploration block, which, like many other companies, we will fund the exploration on a 3,000 square kilometer block to find another Moftino. I think we do have to remember that Moftino has produced almost $100 million of revenue. The fiscal terms in Romania have deteriorated since we began planning the field. So whilst we thought we were going to get some spectacular returns, we only managed to get 113% IRR. 113% IRR is a fantastic investment. So yes, it is declining. Yes, it will ultimately, we will ultimately mothball the plant until we can move it somewhere else or provide more gas to it. But it's been an excellent investment for the company. What is the estimated time to complete the dewatering of the N2 and testing the flow? That is the great question. At the rates we're dewatering now, we don't know how much we don't know the volume we need to take out before, as Stuart says, the matrix can expand the oil into the fractures and start to flow. But we know that the faster we draw the water down, and we've done this on other wells in Sabria, the better. So that's why we would like to acidize to draw that water down faster. But there's very little ways of us to try to predict when those matrix will start opening up, expanding, and allowing the oil into the fractures. So I'm afraid we can't give information. We don't have the information, but we know the faster that we dewater, the better. Are there further G&A expenditure savings the company can make over the short term? Currently looks quite high compared to comparative firms. I'm not sure what comparative firms you're looking at, but our G&A is quite low compared to other producing firms. You need to remember we produce out of 2 different jurisdictions. We're operator in both of those, and we're listed on 2 different exchanges. So given that, we believe we're very efficient on the G&A. I think that shows when we do our competitive analysis against other producers. I think it's unfair to compare our G&A against non-operators or non-producers, because obviously their G&A would be much, much less. But if you compare like for like, the G&A is low. Given the considerable potential in Tunisia, there may be interest from UK firms looking to diversify from a UK tax regime. Will the company look for outside investments or even sale to realize value for shareholders? The company's always for sale. It's just a question of price. So yes, if someone wants to come and make a proposal, I think the current price is ridiculously low. So we would look to extract as much value as possible. Equally, if there's investors that wish to come in, then we're welcome to have them. So if the question is, would we look at a sale? We'll look at anything to try to realize value, and we've done that. What we haven't done is we haven't diluted shareholders. The last time we issued equity was to redeem debt that the company could not service. The company was facing insolvency. And so the shareholders at that time were diluted to relieve the business of that debt burden. Since then, the company has done all the investments we've done in the past on the basis of operating cash flow we generate ourselves. So we've tried to generate value for shareholders by showing that, develop the field of Moftino. The picture on the screen there was a cornfield when I joined. It's now a productive gas plant that earned us quite a bit of return. I'm not sure I understand where the water is coming from on the previous unproduced N2 well in Tunisia. Does it come from drilling fluids or is it a completion issue? Stuart, do you want to address that one?
Yeah, well, the answer is neither of those. It's coming from the water-filled fractures. That at this time of life, water is able to move very freely into the fractures, and that's what's being produced right now. What we need to do is get a bigger pressure drop between the matrix pressure, that's the rock, and the fracture pressure to allow that expansion to happen. So there's water in the fractures right now because of capillary pressure. I hope that answers your question.
Good. While it's difficult times in the market, how confident do you feel for the future? I feel confident. Look, I think the company as a business is running well. We're producing. We are addressing technical issues as they come up and fixing them. The teams are working quite well. And that is not translating into a market capitalization. And so you've got a functioning business that is cleaned up, it's running well, it's operating well, and it's not getting market value for it. So I'm confident that the business continues to run. And over time, I always believe that values will correct themselves. I think the value has to correct itself. This company is not the value of those condensate tanks. It's just not. And that will revert over time. And I think that's the end of the questions that we have here.
That's great, Jeffrey. Thank you very much indeed for updating investors. I know investor feedback will be particularly important to you, Jeffrey, and to the rest of the team, and I'll shortly redirect those on the call to give you their feedback. But if I may, just ask you for a few closing comments, and then I'll redirect investors, as I say, for their feedback.
Yeah, I think the last question about confidence in the future is a great summary for these financial results. The company's generating cash to do its operations. We don't have to go out and look for an asset base. We've got a great exploration asset in Tunisia or in Romania, and we've got a great development asset in Tunisia. So yeah, I'm positive that we continue to develop the assets that we have, explore the assets that we have, and get on with business. So I think that's the conclusion I would say for these results. We're continuing to generate cash. That means we can go out and do our business.
That's great, Jeffrey. Vlad, thank you very much indeed for updating investors this morning. Can I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the company can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of SERINUS Energy PLC, we'd like to thank you for attending this morning's presentation. I wish you all a very pleasant morning.